Hello, everyone. Welcome to the iSectors market review for the first quarter of 2023. I am your host, John Koch, Senior Investment Analyst at iSectors, and I am joined by Vern Sumnicht, the CEO and CIO of iSectors. And Vern is going to give kind of some special commentary to start the presentation about some of the talking points that we've been discussing with advisors and also posting on our website and to our blog and putting out on social media so far this year. So without further ado, I'll let Vern get into it and start talking about some of these economic items we've been seeing.
Hi, John. Thanks. Um, as John said, if you want to visit our website and look at some of our blog posts over the last year, or at least this year to date, you'll notice that we are talking a lot about stagflation. Stagflation being inflation along with slow economic growth or maybe even recession. Um, and this is a very difficult time for the economy. We've had them in the past, but this is turning out to be, I think, a pretty difficult period. The biggest problem, though, that in regards to that we see, especially for our fixed income investors, those living on a fixed uh, income over the next 10 years at least, is going to be inflation. And inflation is caused by just basically too much money. And when the Fed prints too much money, that just dilutes the value of the money, and people want more money, more of those green dollars for whatever goods and services that they're offering you, simply because they don't buy as much anymore. The problem that Fed Reserve has right now is that if they keep increasing interest rates to reduce inflation, then we get recession. If they stop printing money to fight recession, or if they start printing money rather again to fight the recession, then we get inflation. So they're between a rock and a hard place. And if they stop both, inflation is still high. And there's still negative returns for fixed income investors at the bank or in their savings, CDs, and bonds. Um, this makes it very difficult for someone living on that fixed income. So uh, you can't really turn to stocks in that environment. So, what do you do? I think that even if the Federal Reserve uh, does stop printing money and seeing it takes that way, it decides it's going to stop, it's going to live with and it decides it's going to live with the recession. The dollar is still having a problem, and this is inflationary. The dollar is losing its global reserve status, and that's inflationary. So if there's less demand for dollars, it's the same as if there's, greater supply of dollars. So we just really think that uh, a big problem for a lot of retired people or anyone living on a fixed income is this inflation problem. And we need to take a look at how we can kind of fix that, I guess, some ideas. But um, one of the things about rising inflation that and rising interest rates, especially over last year when we saw the greatest increase in interest rates in history. We had a very unprecedented rate of growth in interest rates. And what that's caused is a SEC yield versus a current yield. So the current yield, if you hear that word, that means that basically the yield over the last 12 months, an average yield over the last 12 months. So if you start really low and then as you're getting higher, your average can be pretty low. And yet your current, your what they call the SEC yield or the 30-day yield, that can be much higher. And just as an example, if you look at our domestic fixed income portfolio, a portfolio of laddered bonds that are short term, high quality, the 12-month yield, or what you might see reported as the current yield, is 2.85. And if you look at the SEC yield, net of all iSectors fees today, because of interest rates being much higher, that SEC yield, or maybe the yield that you could expect in the next 12 months is 5.3%, significantly higher than the 2.85 average over the last 12 months, right? Because of rates going up. And I think it's an important point that advisors and investors need to be aware of because of the way that you typically see mutual funds or ETFs or bonds or banks report their yield. You want to know today, now, much more relevant to know what the SEC yield is. Hope that's clear. Anyway, John can show us some more, a little bit more data, but um, another thing that we thought was interesting, we did some research over the last quarter, was looking at our gold allocations, especially post-MPT. Post-MPT growth has about a 30% allocation or close to it in gold. Right now, we've been using gold equities. In the past, we've used bullion, but for the last while, we've been using gold equities. And when we look at this, and this has to do with inflation and has to do with interest rates. If you think about it, so if you're a gold miner, you've got trucks, you've got fuel. There's a lot of capital overhead cost, right? For land, for trucks. What interest rate are you gonna, be able to borrow money at for those capital costs? What's your labor cost and what just the value of those trucks, the prices going up. So that's something that we thought would maybe affecting gold miners. And when we looked at that relative to gold bullion, we found that it's really increased the volatility of the gold miners, right? The miners' value, price of their stock has been going up and down pretty radically, erratically in this environment. So every time gold moves a little bit, it'll drive gold miners either up or down much more than bullion, which moves enough in and of itself, right? Bullion is volatile enough. And so we made the decision to move from the gold miners back to gold bullion at this point. And John can give you a little bit more of we'll show you some pictures and some research on that. Uh, I think I'll turn it back over to John now.
Yes, thank you very much, Vern. So I have some charts and graphs relating both to gold and both to inflation that Vern had touched on, that I'll get to in the next couple minutes here. So first, this chart here shows the cumulative returns for gold miners versus gold bullion over the last 5 years. Gold miners in black and gold bullion in blue, as you can see. Um, if you look over the last 5 years here now, at the beginning and the end, gold miners and gold bullion start at the same place and end at the same place. They both have about a 50% cumulative return over the last 5 years. But to just drive home the point that Vern made about the volatility, especially recently, with miners versus bullion, you can just see it depicted in this chart here. How much more wild the swings are for gold miners versus gold bullion. Um, I think on top of the sort of fundamental things that Vern had mentioned, along with a lot of the back testing we did, this chart sort of sums up exactly what we've been saying with the higher interest rates, higher cost of capital, and everything like that, sort of rolls it all up into one chart. So we thought that was a pretty descriptive way to describe um, that change that Vern had mentioned. And then the other chart that I wanted to show everyone is just regarding inflation that Vern had spoke on. So this is a chart of the year-over-year change in the consumer price index every year over the last 60 years. And as you can see now, where we are, we're at about a 5% year-over-year change. Let me get an arrow there. 5% year-over-year change in the CPI. Now, this is down from the peak that we saw last year, but we are still at about a 5% level of that change year over year. And so I drew the red line going back shows that 5% number going back over those last 60 years. And it's interesting to note there's just a couple things I want to point out on this chart regarding that 5% level of year over year percentage change in the CPI. First, recently, this has been an extremely rare occurrence. This has only happened 2 other times over the last 30 years. One time in the early 90s, which was accompanied by a recession shaded in gray, as you can see, and then one time in about '07, '08 during the global financial crisis was the last time that this happened, also accompanied by a recession. In fact, speaking of recessions and this 5% level of CPI change, of the recessions shown on this chart over the last 60 years, there's been 8 recessions. 6 of them have seen levels of CPI change this high. The only 2 that haven't was the early 2000s tech bubble and the sort of flash recession in 2020 caused by the COVID pandemic, which, you know, this high level of recession is almost a direct result of how the Fed handled that crisis in 2020 and how they chose to get us out of it. And so these numbers in this chart sort of just shows, the type of risks that can accompany levels of inflation this high, at least on a historical basis. And so, speaking of inflation being that high and what you can potentially use to invest in during times like this, iSectors has 2 models that hope to solve this problem directly in the iSectors inflation protection allocation and the iSectors precious metals allocation. In fact, if you look at the chart on this page, we're charting the last 5 years of these 2 models against monthly changes in the CPI now, not year-over-year changes. We're showing monthly changes here because that's the benchmark for these models that you'll be able to see on the fact sheets on the website for both of these models over the entire history, the entire track record for both these models. But here we're showing the last 5 years just to kind of encapsulate the most recent data that we have. Both models do a pretty good job keeping up with inflation over those last 5 years. Precious metals performing a little better than inflation protection, and that's mainly due to inflation protection being a broader allocation of inflation protection type of assets, real assets, real estate, broad commodities, gold and silver bullion, short-term tips, things like that. Whereas precious metals is direct exposure to gold, silver, platinum, and palladium bullion. Now you also see that accompanied with that higher return of the precious metals model is a higher volatility. So we kind of have 2 solutions here, one for clients who may have a little higher bit of a risk tolerance, and one for maybe more moderate or balanced clients who want a lower volatility profile in the name of the inflation protection model. So speaking even more recently in the 5 years, we'll talk about the first quarter now. Both models had modest positive returns in the first quarter, which you'll be able to see on the next slide. We'll have the exact numbers along with all of our other models. Broad commodities pulling back in the first quarter hurt the inflation protection model more than the precious metals model, and that's why the precious metals model outperformed in the first quarter. But gold and silver returns that are present in both models helped inflation protection quite a bit. It also helped the precious metals allocation, obviously, because it has a higher allocation to gold and silver. But poor performance from platinum and palladium did hold back returns a bit in the precious metals allocation from being even higher. One more note I'd like to make about the inflation protection allocation before we get into sort of the full review or full look at all of our models. Over the last 3 years, the inflation protection allocation has the best Sharpe ratio of all the iSectors models. In fact, it actually has a better Sharpe ratio than even the S&P 500 over the last 3 years. So if you'd like any more sort of little tidbits like that about our models, you can reach out and we can provide any sort of custom date ranges you want to see. If you don't want to see 5 years, if you want to see 3 years, or any time shorter than that, we'd be happy to help provide that to you. And now moving on from sort of a specific view at some of our models to a more broad overview of both our models and how some of the broad equity and fixed income markets performed in the first quarter. If you look here, the S&P 500 had a very good quarter, returning about 7.5%, which is good on the surface. That's, people are happy when the stock market does well. However, we have found that about 60% of that return can be attributed to only 5 stocks so far this year. Those stocks are Apple, Microsoft, Nvidia, Meta, and Google. In fact, Apple, the number 1 stock in that list, actually has the highest weighting in the S&P 500 of any stock since 1980, of any stock that has ever been in the model, or not in the model, sorry, in the index. It has a 7.1% weighting right now, the highest ever. The models we have, we personally don't really try to get that concentrated. We like a broader allocation. For example, in our domestic equity allocation, we have an overweight to quality dividend and value type of stocks versus growth stocks. Sure, we still own some of those names that I mentioned, but it's much more broadly diversified. It has a higher allocation to companies that have paid consecutive dividends over the past, 20, 25 plus years. That's really the type of exposure that we prefer. Some other sort of notes, some highlights from the quarter. Bonds had a decent quarter. The Bloomberg Aggregate Bond Index had about a 3% return in the quarter. Commodities had, as I mentioned earlier, with the inflation protection model, pulled back a bit in the quarter, down about 5% over the last 12 months. The commodity index is down about 10%. A lot of that has to do with, like Vern said, the weakening of the US dollar has played into that quite a bit. So speaking of the US dollar, and just to hit on, we're just going to do a quick hit on just a couple of our other models because we really don't want to have this thing go much longer than 15, 20 minutes. The iSectors crypto block allocations did very well this quarter, 40% plus for crypto block 1, 26% plus for crypto block 2. Again, mainly due to the weakening dollar has been very good for Bitcoin. The price of Bitcoin's now has, well, not now, but has gotten up over 30,000 in recent times, down from the high of about 60,000. So that really buoyed returns for this model in the quarter. Our endowment allocation, I just want to hit on that to not necessarily talk about returns, but to talk about the yield number that Vern had talked about. This model is currently throwing off about a 6.9% SEC yield, net of iSectors fees. So if a client is looking for high current income and wants and isn't as concerned about capital preservation and wants a more balanced type of portfolio that'll hold equities, fixed income alternatives, the endowment allocation could work for that particular client. We could spend a lot more time on this chart, but what would really work out better is if you visit our website. You'll be able to view this video and read in even more detail about all of these models, what drove outperformance and underperformance during the quarter, some of the recent model changes we made. It's all available on our website. It'll be posted with this video. So please be sure to check that out. I feel like our website sometimes goes overlooked, and it's really a great resource for any advisor who uses our models, or even those who don't, to learn more about us. So for any further detail about our other models, please make sure you reach out and or visit our website for that written commentary. Now, while I show the disclosure page here, I want to speak about reaching out and trying to schedule meetings with us. If you want to contact us directly, that's perfectly fine. But also, as I mentioned, on our website, we do have a booking tool directly on our website now. So at any time, you can visit it and set up a meeting, and you don't even have to try to work with us to set something up, which some advisors have found very convenient. However, if you do want to reach out directly and talk to us, I offer my contact information and Scott Jones, our Director of Business Development's contact information, both our email addresses, phone numbers, and Twitter handles. If you want to follow us on Twitter, we'd really appreciate that. We've been posting a lot of content, like Vern mentioned earlier, articles, blogs, all in the same vein of just what we're seeing now in the economy, how it relates to our models, what we think this means going forward, things like that. So you can follow either Scott or I, our handles are there, or you can follow our main iSectors account, which is just at iSectors. We would really appreciate it, and it's really the best way to see how we're thinking on a day-to-day, week-to-week basis, as opposed to just sort of sporadic updates once a quarter, once a month. So besides that, I think that's pretty much everything we wanted to talk about today. Vern, I don't know if you have anything else to add, but I think if that's it, we'll probably wrap it up here, and we can get everyone on their way.
Thanks, John.
Perfect. Okay, that sounds good. Thank you, everyone. Have a great day, and thank you for watching.